Let's dive into the world of index investing. It's a fascinating topic that has gained a lot of traction in recent years. Index investing is a passive investment strategy that seeks to replicate the performance of a specific market index, such as the S&P 500, NASDAQ 100, or Russell 2000. Here are the key aspects. Index investing is a strategy of investing in a portfolio designed to track a specific market index. The goal is to achieve market returns with low fees, minimal effort, and reduced risk compared to actively managed strategies. So, how does index investing actually work? Investors purchase index funds, which can be mutual funds or exchange-traded funds, designed to replicate the performance of an underlying index. For example, there are S&P 500 index funds, like SPY and VOO, total stock market index funds like VTI, and international index funds like the MSCI Emerging Markets Index. Now let's talk about the weighting of indices. In a market cap weighted index, stocks are weighted based on their market capitalization, like in the S&P 500. In an equal weighted index, each stock in the index is given equal weight. There are also other weightings, such as sector weighted or fundamentally weighted indices. And remember, index funds are passively managed. They aim to replicate the index's performance rather than outperform it. What are the advantages of index investing? Well, for starters, index funds typically have lower expense ratios compared to actively managed funds due to minimal management and research costs. They offer broad diversification, providing exposure to multiple companies, sectors, or asset classes, which reduces individual stock or sector risk. Another benefit is simplicity. Index investing is easy for beginners to implement without requiring active stock picking or market timing. Performance-wise, historically, index funds often outperform actively managed funds over the long term due to lower fees and efficient market exposure. Additionally, index investing offers transparency. Investors know the exact composition of the index and can track performance easily. Finally, passive strategies have fewer transactions, leading to fewer taxable events compared to active funds. So there you have it, the many advantages of index investing. Index mutual funds, funds that pool investors' money to buy assets that replicate the index, typically have higher minimum investment requirements than ETFs. Exchange-traded funds, or ETFs, trade on stock exchanges like individual stocks, offer greater flexibility, intraday trading, and lower initial investment requirements compared to mutual funds. Domestic indices, S&P 500, tracks the 500 largest U.S. companies by market capitalization. Dow Jones Industrial Average, or DJIA, tracks 30 large-cap U.S. stocks. Russell 2000 focuses on small-cap U.S. companies. NASDAQ 100 comprises the largest 100 non-financial companies listed on NASDAQ. International Indices, MSCI Emerging Markets, covers stocks from emerging economies. FTSE 100 tracks the 100 largest companies on the London Stock Exchange. Sector-specific indices. Indices that focus on particular industries like technology, healthcare, or energy. Market risk. If the overall market or index declines, the fund will also decline as it mirrors market performance. Lack of flexibility. Index investing does not allow for strategic adjustments based on market opportunities or specific stock analysis. Limited downside protection. Passive funds do not include hedging or defensive strategies during market downturns. Concentration risk. Market cap weighted indices may become heavily weighted toward a few large companies, reducing diversification. Expense ratio measures the fund's annual operating costs as a percentage of assets under management. Lower is better, for example, 0.03% for some funds. Tracking error indicates how closely the fund's performance mirrors the index. A low tracking error is preferred. Liquidity High liquidity ensures easy trading for ETFs and mutual funds. Dividend yield. Many index funds pay dividends based on the underlying stocks in the index. Choose an index. Decide which index aligns with your investment goals, for example, U.S. large cap stocks, global exposure, or sector focus. Select a fund. Pick an ETF or mutual fund that tracks your chosen index. Compare expense ratios, performance, and fund size. Set investment goals. Define your time horizon and risk tolerance. Adopt a dollar cost averaging strategy. Invest fixed amounts periodically to reduce the impact of market volatility. Monitor periodically. Review your portfolio occasionally to ensure alignment with your goals, but avoid frequent trading. Index, S&P 500, Fund Options, ETF, SPDR, S&P 500 ETF Trust, SPY, with an expense ratio of approximately 0.09%. Mutual Fund, Vanguard 500 Index Fund, Admiral Shares, VFIAX, with an expense ratio of approximately 0.04%.